You know, what if the entire cathedral of modern finance, all of its elegant equations, all its powerful models, was built on a single, beautiful, but flawed assumption? Today, we're going to explore that flaw. It's like a hidden crack in how we price the future, and it has massive implications for the resilience of our entire financial world.
So, let's start with a really powerful thought experiment. Just imagine for a second that we could design a perfect market. I mean, a system so complete, so mathematically elegant that it could put a precise objective price on every single thing that could possibly happen in the future, from a market crash to a crop failure. Imagine a world where all risk could be perfectly hedged away, a world with zero uncertainty. Now, this isn't just some fantasy. This is the theoretical blueprint that modern finance was actually built on. It's this ideal world where risk stops being this terrifying unknown and it just becomes another commodity, something you can precisely price, buy, and sell. And the technical name for this perfect world is a complete market. In this sort of theoretical utopia, you could buy a financial instrument to protect yourself against literally anything. The risk of losing your job, a project failing, a supply chain breaking, all of it could be perfectly insured, transforming all that catastrophic uncertainty into just a manageable cost. And a building block for this perfect market is, well, it's surprisingly simple. It's an idea called a state contingent claim, which is just a fancy term for a simple bet, right? Think of a coin toss. You could buy one contract that pays you $1 if it's heads and another one that pays if it's tails. The whole theory is, if you combine enough of these simple atomic little bets, you can build a perfect hedge against any complex outcome you can dream of. The intellectual giants who gave us this blueprint were Kenneth Arrow and Arrow-Debreu, with their famous Arrow-Debreu model. And its conclusion was just profound. In a complete market, every single risk has one and only one correct price. It's not a matter of opinion or sentiment, it's a mathematical certainty. But this is where the beautiful theory just smashes into messy reality. Because the moment we step out of the textbook and into the real world, that perfect blueprint shatters, and it reveals the true and often messy price of uncertainty. So, in the world of theory, you've got this powerful piece of math called the second fundamental theorem of asset pricing. It acts as the linchpin for the whole thing. It's the mathematical engine that takes all those possible futures and distills them down into one single correct price for any asset. It's what holds that perfect world together. But here it is. Here's the flaw. In the real world, that theorem doesn't hold. The strict conditions it needs, the ability to trade continuously with no friction for every possible outcome, they just don't exist. Our world is not the model. Our market is incomplete. And this chart really shows the critical difference. In that perfect, complete market, there's a unique way to adjust for risk, a single, equivalent martingale measure, or EMM, that gives us one objective price. But in our messy, incomplete market, there isn't just one way to measure risk, there are many. And that little fact, that multiplicity, it changes absolutely everything. So what does that actually mean? Well, here's the core consequence. Because the market is incomplete, it can no longer give us a single objective price. The best it can do is provide a range of possible prices. It creates this zone of ambiguity where the fundamental law of no arbitrage, the idea that you can't make a risk-free profit, still holds, but it no longer spits out a single answer. Think of it like a negotiation. A really cautious seller is only going to offer a complex insurance contract at a very high price. That's the superhedging price, which guarantees they can't possibly lose money no matter what happens. A rational buyer, on the other hand, is only willing to pay a much lower price. The fair value is somewhere in that huge gap between them, and pure mathematics alone can't tell us where. And this transition really is the heart of the matter. It's been said that market incompleteness transforms derivatives pricing from a pure engineering exercise into a profound economic problem. It's no longer just about calculation. It becomes about human judgment, risk appetite, and what you believe about the future. Okay, so faced with all these uninsurable gaps, what does finance do? Well, it innovates. It creates new things. But as we're about to see, this kind of innovation is a real double-edged sword. Let's take the most infamous example, the Collateralized Debt Obligation, the CDO, which was right at the heart of the 2008 crisis. On paper, the idea seemed brilliant. You bundle thousands of mortgages, then you slice them up to diversify the risk of any one homeowner defaulting. It was a genuine attempt to complete the market. But it didn't actually eliminate the risk. It just hid it,
concentrating a single, catastrophic, and completely uninsurable possibility. What if the entire housing market falls all at once? And right here is where we find something called the risk paradox. You have these financial innovations that are designed to help individual firms hedge their risks, to complete their little piece of the market. But in doing so, they can actually make the entire system more fragile. The risk isn't gone. It's just been transformed and shifted, often into something new and, frankly, way more dangerous. Now, this fundamental flaw isn't just some theoretical curiosity for academics and traders. Oh no, it imposes staggering real-world costs on the entire economy.
So because markets are incomplete, you create the conditions for liquidity crises to even exist. Shocks to our ability to share risk can, all by themselves, trigger actual recessions. It makes monetary policy less effective, and maybe most importantly, it leaves ordinary households exposed to these life-altering, uninsurable risks, like a sudden loss of income.
And the scale of this cost, it's just staggering. Research estimates that our inability to insure against these basic household risks imposes a welfare cost on society that's equivalent to 20% of total consumption. Think about that. It's like an enormous, invisible tax that's being levied by the market's own inherent incompleteness. So, if this flaw can't be engineered away, what's the alternative? Well, the answer isn't to fix it, because you can't. It's to embrace it. To learn how to manage a system that we know, for a fact, will always be incomplete.
The first and most important step is a huge shift in mindset. We have to stop seeing market incompleteness as a bug that we need to fix. It's a fundamental feature of our financial world. The goal can't be perfection, it has to be resilience.
Just look at the major regulatory reforms after 2008. The problem was seen as counterparty risk, the fear that the bank on the other side of your trade would just go bankrupt. So the solution was to mandate these central clearing parties, or CCPs. But CCPs don't eliminate risk, they just transform it. They take all this dispersed counterparty risk from many different firms and concentrate it into a massive liquidity risk right at the very center of the system. It's a trade-off, it's not a cure. And this really reveals the ultimate danger in an incomplete world. The biggest threat is no longer just that the market is going to move against you. The primary threat becomes something called model risk, the terrifying possibility that the map you are using to navigate reality is itself fundamentally wrong. This forces a profound shift in thinking for investors and regulators alike. The expectation of achieving perfect replication or unique valuation must be abandoned. The goal can no longer be perfection. Instead, as the quote says, the focus must transition toward resilience, building systems that can withstand shocks and survive their own inevitable flaws.
And so, that leaves us with a final, really profound question. Finance gives us these maps to navigate the uncertainty of the future. But we now know these maps will always have blank spaces, edges that should be marked, "Here be dragons." So the ultimate challenge, then, isn't to create a perfect map. It's this. If our maps are always destined to be incomplete, how do we learn to navigate the storm?